Hello, dear friends. My name is Nathan. Today, I want to begin with a warning because what just happened in gold and silver was not a normal pullback. It was not a tidy correction. It was not the kind of move you can shrug off and pretend it's healthy volatility. It was a liquidation event. And if you want one line that locks trust immediately, here it is. Reports put gold down roughly in the high single digits to low double digits on the day, around 9 to 12%, while silver fell around the high 20s% and at points was down roughly 30 to 35% intraday. That is the definition of a market hitting constraints, not gently repricing fundamentals. Now let's talk about the number that's been blasted across feeds. $7 trillion wiped out. Here's the clean, honest version, because this is where people either get fooled or get dismissive. Nobody watched $7 trillion of cash vanish from their personal brokerage account overnight. That figure is an estimate of implied repricing. It's usually calculated using a simple logic. Take an estimate of above-ground gold and silver, multiply by spot prices, and then look at how much that implied market value changes when spot falls sharply. It's above-ground supply x spot price change, used as a scale indicator. And yes, that estimate has been circulated by major outlets, including Yahoo Finance and MarketWatch, using that exact logic to communicate the magnitude of the repricing. Yahoo Finance specifically framed the wipeout at roughly $7.4 trillion using the above-ground supply and spot move approach. So treat it as what it is, a way to express scale, a way to say this wasn't small, not a literal $7 trillion exited bank accounts today. But here's the part you really need to understand. A repricing big enough to justify that framing doesn't happen in a calm, balanced system. It happens when the market was already structurally unstable before the catalyst arrived. This is not about whether you like the headline. This is about what the headline implies. The move was violent enough to mark-to-market global inventories and produce a staggering number. And today I'm going to do this the professional way. Not doom theater, not narrative worship, mechanisms, signals, and falsification. So you leave this video calmer, not more panicked. 3 things. First, I'm going to anchor what happened in a way that tells you who was forced and why the chart looked irrational, even though the plumbing was completely logical. Second, I'm going to walk you through what really triggered the crash. Spoiler, it wasn't one villain. It was a chain. Crowded leverage, a macro catalyst, tightening risk controls, and forced liquidation that turned a sell-off into air pockets. Third, I'm going to give you a checklist of signals you can watch yourself, and I'm going to tell you where to check them because watch credit is useless advice unless you know what to watch and how to prove a claim wrong. Now, one micro favor, and I'll keep it short. If you want more mechanism-based analysis like this, frameworks, real signals, and falsification tests, hit subscribe. All right, let's get into it. Most people think crashes are caused by news. They imagine a headline appears and the market calmly changes its mind about value in a synchronized way. That's how the story gets told because humans love simple stories. But real crashes are usually constraint events. A constraint event is when the system hits a hard limit. Funding gets tighter, margin requirements rise, risk limits clamp down, liquidity providers widen spreads or step away, the cost of carrying positions jumps, the ability to finance or roll exposure becomes uncertain, and suddenly people aren't selling because they want to. They're selling because they must. So here's the adult question you should ask. Was this a belief event or a constraint event? Belief changes slowly. Constraints change fast. A one-day move of this scale, especially in silver, is almost never a pure belief-changed overnight story. It's the system obeying constraints. Now I'm going to say something that will save you from 90% of bad content. The trigger of a crash is usually not the thing that caused the instability. It's the thing that exposed the instability. Think of it like a shelf stacked too high. It stands there looking fine until the smallest bump arrives. The bump is not the cause. The unstable stacking is. So if we want to know what really triggered the crash, we need the full chain, not a single headline. And the chain, as reported and framed across major outlets in different ways, looks like this. First, the trade became crowded and leveraged. Prices ran in a way that rewarded confidence, then rewarded arrogance, then punished humility. The rally became parabolic enough that the market stability began to depend on continuous risk appetite. Second, a macro catalyst hit that shifted expectations. Multiple outlets framed the spark as the reported news that President Donald Trump would nominate Kevin Warsh to lead the Federal Reserve. And I'm going to add the missing bridge that makes this feel inevitable rather than story-based. That kind of headline matters because it can flip rate and dollar expectations fast. When rates and the dollar narrative shifts in a crowded metals trade, the marginal buyer can turn into the marginal seller in hours. Third, risk controls tightened across venues. Reports pointed to successive margin increases and broader de-risking behavior. That's the mechanism reported across multiple outlets line made concrete. Margin hikes and risk tightening squeezed leverage and accelerated liquidation. Fourth, forced deleveraging created air pockets, liquidity thinned, bids stepped back, spreads widened, slippage exploded, and the move fed itself. Price drops triggered margin calls forced selling, selling pushed price lower, and the whole thing started looking like the market was broken. That chain is what really triggered the crash. Not one headline, not one villain, a fragile structure plus a catalyst plus tightening constraints. Now let me slow down and explain the single most important mechanism in this episode. Because if you understand this, you will never be easily fooled again. Margin. Margin is the cash collateral required to hold leverage positions. When an exchange raises margin requirements, it raises the cost of leverage. It's saying, if you want to keep holding this exposure, post more cash. If you have the cash, you can hold. If you don't, you must reduce or close the position. So, in a crowded leveraged market, margin hikes don't calm things down in the way people naively assume. They can force liquidation right into weakness, especially when the market is already moving fast. And this is where silver becomes the star of the show for all the wrong reasons. Silver is structurally more volatile than gold. It's thinner. It often attracts more speculative positioning. It's a hybrid, traded like a financial instrument and used like an industrial input. That combination makes it sensitive to both macro narrative shifts and forced de-risking. So when the system demands cash and tightens risk controls, the most volatile piece of the complex tends to get hit hardest because it becomes the hardest to carry. This is why silver's day looked like a trapdoor. Now let's talk about the psychological mistake that ruins people after a crash. People see a crash and say, it must be over now because it was mechanical. Not necessarily. A margin-driven crash can be contained if forced selling exhausts and if credit and funding conditions remain stable. In that case, the market stabilizes, volatility cools, and price starts responding more to normal supply and demand. But a margin-driven crash can also be the beginning of a higher volatility regime if it damages confidence and causes risk managers to remain conservative. In that environment, liquidity stays fragile, and even small catalysts can create outsized moves. So the crash itself is not the end of the story. The crash is the first chapter. The question is, what happens next? Stabilization or continued propagation of stress? This is where we stop entertaining ourselves and start being credible. I'm not going to ask you to believe my thesis. I'm going to give you a falsification test that can prove me wrong. Here it is. If credit spreads remain contained, short-term funding conditions remain orderly, and hiring behavior remains stable in leading indicators over the next several weeks, then this episode was more likely a violent positioning reset, a purge, a painful cleanup, dramatic but contained. If, however, credit spreads widen persistently, short-term funding stress rises, lending terms tighten and hiring behavior softens, then this was not just a cleanup, it was a system flare. And if it was a system flare, the real economy can feel it faster than most people expect. Not because gold causes recession, but because credit is the economy's oxygen. Let me make that plain. Credit is upstream of employment decisions. When lenders get nervous, they tighten terms. When terms tighten, businesses reduce spending and slow expansion. When spending slows broadly, hiring slows. When hiring slows across sectors, recession risk rises. That chain is plumbing, not ideology, not politics, plumbing. Now, you demanded something that most finance videos refuse to provide. Where do I check these signals? You're right. Signals without locations are useless, so let's do this properly. Simple, actionable, and not overwhelming. If you watch only one recession risk gauge, watch high-yield credit spreads. A common public series people use is a high-yield option-adjusted spread because it reflects how much extra yield investors demand to hold risky corporate debt. You don't need to understand every detail. Watch trend and persistence. If spreads rise and stay elevated, risk appetite is deteriorating. If you want a macro pressure gauge that matters for metals, watch the dollar's behavior and rate expectations. In a world where metals are traded as macro instruments, shifts in rate and dollar expectations can change positioning fast, especially if the trade was crowded. If you want the most direct mechanism signal, Watch risk controls. That means whether venues and brokers keep tightening margin requirements, limits, and collateral demands. If tightening continues, volatility often persists. If tightening stabilizes, it can be a sign that forced selling is fading. If you want behavior evidence, watch flows. Flows can show you whether some participants are being forced out while others are leaning in. When you get significant buying into panic while leverage is being flushed, it tells you the move is not a neat, unified change in belief. It's forced selling meeting patient money. Now let's talk about the signal that most people ignore because it's not on the screen: physical friction. During this episode, multiple reports describe the real-world pipeline getting stressed in ways that confuse casual observers. One set of reports described coin shops being flooded with sell-in and refineries being overwhelmed or backlogged, meaning the bottleneck wasn't nobody can get metal. It was the system can't process the flow cleanly. Other trade and industry reporting described refiners limiting intake or slowing processing and, in some cases, delaying payments, which pressures cash flow in the dealer chain. Why does that matter? Because it proves the same point. Constraints create stress. Whether it's trading constraints or operational constraints, the system doesn't need a conspiracy to break. It needs friction. And friction is where confidence goes to die. Now let's tighten the core explanation into one clean sentence, because retention matters, and over-explaining is how you lose people. This crash was a crowded, leveraged metals trade colliding with a macro expectation shift and tightening risk controls, especially margin, forcing liquidation through thin liquidity, producing air pockets large enough that media framed it as an implied multi-trillion-dollar repricing. That's the mechanism. Now we pivot to what you do with it, because information without action becomes anxiety, and anxiety is expensive. First, separate your buckets. If you trade paper exposure, futures, options, leverage products, you need strict sizing rules, defined risk, and a plan for margin changes. Your survival depends on it. If you hold physical metals as long-term insurance, do not treat that like a day trade. Insurance is not meant to be churned every time you feel nervous. If you churn it, you pay spreads and fees until you resent the asset itself, when the real problem was your decision frequency. If you do both, separate them mentally and operationally. Different time horizons, different rules, different goals. Second, reduce decision frequency. Whiplash markets punish people who feel the need to do something every day. You do not get paid for activity. You get paid for correct activity. The market's job is to extract money from the impatient. It does it by manufacturing pain, drops for long, spikes for shorts, randomness for everyone in the middle. If you respond to pain with impulsive action, you become liquidity. Third, be honest about leverage. If your position requires calm conditions to survive, you are positioned incorrectly for a market that has turned violent. Ask yourself a brutal question. Could you survive a 20% swing without being forced out? Could you survive a silver-style intraday move without blowing up? If the answer is no, then the position is too big, or the leverage is too high, or the instrument is wrong for you. There's no shame in that. The shame is pretending you can stomach volatility that your sizing makes impossible. Fourth, write your plan down, not in your head, on paper. What are you doing if gold snaps another 5% in a day? What are you doing if silver whips 10% intraday again? How often do you allocate to physical? What's your risk budget for paper exposure? Under what conditions do you stop trading? Under what conditions do you add? Under what conditions do you do nothing? A written plan is how your calm self rescues your emotional self. And in a whiplash regime, that rescue is everything. Now, let's address the recession angle carefully, because this is where people either get sober or get stupid. Do crashes like this automatically mean recession? No. Crashes like this mean the system just revealed fragility. Recessions are not caused by one asset class moving. Recessions are caused by broad changes in spending, hiring, and credit availability. But here's what people underestimate: propagation speed. When uncertainty rises and credit tightens, decision cycles compress. Businesses don't wait for a quarter to end to become cautious. They pause, they delay, they review, they tighten. That's why you hear 3-week window talk, not as magic, as propagation, as a realistic time frame in which a stress flare can turn into change behavior if the conditions persist. So here is the disciplined version, softened and accurate. Stress can propagate through the system over the next 1 to 3 weeks to several weeks because the chain is sequential. Markets react immediately. Risk desks and lenders react next. Businesses react after that. Consumers react after that. This doesn't always happen. Sometimes the system absorbs the shock and stabilizes. But when you start from a fragile baseline, propagation becomes more likely. And the baseline matters. We are starting from a world where leverage exists in more places than people admit. Not just in trading accounts, in corporate balance sheets, in private credit structures, in real estate financing, in consumer credit. We are starting from a world where refinancing assumptions are baked into behavior and where confidence itself is is part of the engine. So when confidence takes a hit, businesses don't announce panic. They announce caution. They pause. They delay. They review. They cut discretionary spending. They freeze hiring. They reduce inventories. They tighten vendor terms. That review period is where recession-like conditions are born. Now, I'm going to warn you about something subtle that's about to happen in your feed, because it happens every time. After a crash, everyone becomes certain in hindsight. They will tell you they predicted it. They will tell you it proves their worldview. They will tell you the other side is stupid. They will sell you emotion because emotion is profitable. Your defense is simple: the falsification test. If the signals don't confirm the story, discard the story. That's how you stay rational. Now, there's one more practical thing you should understand about this episode, because it's how you avoid being emotionally baited by the rebound. After constraint-driven crashes, markets often snap back. People interpret the snapback as proof the crash was fake, or they interpret it as proof the bottom is in. Both are emotional interpretations. Often the rebound is simply the market snapping back when forced sellers finish dumping and short sellers cover. It's not necessarily a return to stability. It can be a relief rally inside a fragile regime. So if you want to know whether stability is returning, don't stare at the price alone. Watch constraints. Are margins still tightening? Are spreads widening? Are funding conditions calm or jumpy? Is credit expanding or contracting? Is hiring stable or freezing? Now let's do a clean weekly routine that keeps you informed without making you obsessive. Once a week, check a high-yield spread series and look for trend and persistence. Once a week, check whether risk controls keep tightening across venues. Once a week, check the tone of lending and business commentary. Are terms tightening? Once a week, check hiring behavior through leading indicators like job postings and guidance language. And once a week, check physical chain friction signals, premiums, backlogs, processing constraints, dealer behavior, because operational constraints can appear even when the chart is confusing. That's it. You don't need 50 indicators. You need a few good ones and consistency. Now let's bring it home by answering your title question one last time in the cleanest possible language. What really triggered the crash? A fragile leverage structure met a catalyst that shifted macro expectations, especially around rates and the dollar. At the same time, risk controls tightened through margin and de-risking, forcing liquidation through thin liquidity. That is the trigger chain: crowded leverage, macro catalyst, risk tightening, forced liquidation, air pockets, implied multi-trillion repricing on global inventories. Now, the only thing that matters is what happens next. Does the system stabilize, or does it tighten further? Here's the simple decision tree you should keep in your mind. If credit spreads remain stable and contained, that's a stabilizing sign. If spreads widen and stay wide, that's stress. If funding conditions remain orderly, that's stabilization. If funding conditions get jumpy and lenders tighten, that's stress. If hiring remains stable in leading indicators, that's stabilization. If hiring freezes spread, that's stress. If markets stop changing rules and stop tightening risk controls, that's stabilization. If risk controls keep tightening, that's stress. This is how you stay sane in a world that wants you emotional. Now, I want to end with a cliffhanger that is actually useful, because it forces you to think in scenarios instead of certainties. After a liquidation event like this, markets typically do one of two things. They stabilize and rebuild because forced sellers are exhausted and risk controls stop tightening. Or they enter a chop-and-trap regime where volatility stays elevated and the market keeps whipping to punish both sides while the system continues to clear uncertainty. Which one happens depends on constraints, not opinions. So here are the two questions I want you to answer in the comments, because it forces clarity and it helps everyone watching think better. First, do you think the primary trigger was the macro narrative shift around the reported Fed chair pick? Or do you think the bigger trigger was the margin squeeze and successive de-risking? Or was it the combination that made the trade unstable? Second, over the next several weeks, if you could watch only one signal, would you watch high-yield credit spreads, short-term funding stress, or hiring behavior? And why? And one last micro CTA, then I'm out. If you want the follow-up when we can see whether this was a contained liquidation or the start of a higher volatility regime, subscribe so you don't miss it. Ladies and gentlemen, my name is John A.G. Stay calm, stay disciplined, and write your plan before volatility writes your emotions. Bye-bye for now.